Good afternoon. Good afternoon. Happy Tuesday, the 13th of February. My name is Thilan Vikramasinghe. I'm the head of research for Maybank Securities in Singapore. And welcome to our show. And before I start, I want to wish all of you Gong Si Fa Chai. I hope you had a very good Chinese New Year break and wish you all the prosperity for the year to come. Um, Let's look at markets. China, Hong Kong, Taiwan markets were closed last week, last Friday, and they continue to be closed for CNY holidays. The S&P crossed the 5,000 mark, and the AI frenzy still doesn't seem to be, still has quite a bit of legs going for it. But China's inflation actually fell the sharpest in 14 and a half years. What does this mean? I'm going to bring you the latest thoughts from our macro team. But it also means when the dragon sleeps, does that mean the tiger comes out to play? There's quite a few ASEAN stocks that are looking quite attractive in terms of valuation as well as growth. And DBS is one of them, and we're going to talk a little bit about that. We also have a new initiation with Airports of Thailand. Bunyakorn is online to take us through why he thinks this stock is a buy right now. And then finally, we've got a gem of a stock in the small and mid-cap space, 55% upside. So stay till the end to find out what that is. Let's go with market movers. North Asian markets are mostly closed on Friday. We did see Indonesia rising about 0.9% last week, mostly as you're starting to see some clarity in terms of the front runners for the election and also expectations of higher spending on the back of the elections. We saw Thailand also coming up a little bit, partly as expectations of tourism coming back as well. STI and KLCI were generally weak. Bitcoin crossed the $50,000 mark again. So that's something to watch out for. I think there's a little bit more risk being put onto the markets. Now, let's look at China. Erica has put out a timely piece noting that China's January inflation actually fell 0.8%. This is actually worse than what economists were expecting. And it was also the steepest fall in inflation since September 2009. Prices outside food and energy were also cooling. So it's not just on some of the core stuff. Sequentially, there has been some improvement on month for areas such as food, but we think a large part of this could be just festive restocking ahead of Chinese New Year. So whether this momentum can continue after Chinese New Year is something to be seen. Now, if policymakers can arrest this upstream deflation, and that's a big if, then we think that overall, China should be able to break the overall deflationary cycle. If they manage to do a few things, we think that by the end of the year, inflation in China should be back up to about 1.1%, and then it will grow to about 1.5% in 2025. But for that to happen, there needs to be a very concerted effort from the government. We think that there could be more official statements coming out from the Chinese government committing to an inflation target. When you have a target, it helps with planning, especially for companies as well as for individuals. We think there'll be more steps taken to boost consumer demand by direct fiscal spending, and also giving a lot more social safety nets. Having social safety nets will alter consumer behavior towards spending more rather than doing precautionary savings. We also think that there'll be a lower support for manufacturing going forward, particularly from a policy point of view, because right now manufacturing already has a lot of excess capacity in China, particularly in areas like the EVs and renewables. So I think shifting some of that capacity away from the manufacturing sector should also help with inflation. We think also that the People's Bank of China, the central bank, may actually cut prime rates to around 3.3% from around 3.45% now. But this may not have a big impact because loan demand is also already quite weak as it stands. But that at least shows a step in the right direction in terms of trying to kickstart the overall economy. So these are some of the things to watch out for over the next few weeks and months, particularly after the Chinese New Year season, to see whether China can try to arrest the upstream deflation that they have been facing so far. But as I said, there's a lot of ifs there. So, our macroeconomists have, coined the term the lethargic dragon for China for this year. But this actually gives a good chance for the speedy tiger in Southeast Asia to take a much more prominent role in markets. And I think if you look at Southeast Asia, and this is something that we have been saying quite regularly, is that valuations are extremely cheap, and you actually get some very good quality companies that are paying some very strong dividends out there as well. DBS is one of those stocks trading at 1.3 times book, delivering around 16% return on equity. This is amongst the highest ROEs for a lot of developed market banks. In fact, it's actually amongst the high ROEs for some of the developing market banks as well, with a AAA credit rating. The fourth quarter results were actually quite good. We think they actually have enough levers to maintain the current sort of level of profitability going into 2024 as well. They can drive more loan growth. They can get more higher fees, particularly from the wealth management side. Remember, they were one of the big beneficiaries of a lot of AUM coming from areas like China, the overall North Asia, as well as Europe and Middle East and so on, as well as Southeast Asia, given all this volatility that was around last year. We also think that there is a potential for them to write back a lot of provisions that they took during the COVID period. They're sitting on over $2 billion of provisions. So some of that can also be given back to shareholders. So a lot to look forward to there. One of the more positive trends that we are seeing, and one of the reasons we are getting a lot more confident of this, is the fact that asset quality is actually holding up quite well. Non-performing loans, new non-performing loan creation actually fell by around 43% quarter on quarter in the fourth quarter. So NPLs are falling despite higher interest rates and slow economy. So that's a good sign in terms of the health of a lot of their customers. Of course, one of the areas where investors have come to me and said they're quite concerned about is DBS's commercial real estate exposure. I mean, I'm sure a lot of you are aware, in the US, the commercial real estate sector is having a very, very tough time. So there is some concern about asset quality going into the commercial real estate sector. Now, this is important to talk about for a minute for DBS, because around 1/5 of their loan book is commercial property. But 60% of that is in Singapore, and the fundamentals for office space and commercial property in Singapore is very, very different. In fact, vacancies in office space in Singapore is actually quite low, particularly in the CBD. Another 20% is in Hong Kong, but a large part of that is to high-end corporates, so the big conglomerates. So again, there is some risk, but it's something that can be managed. Then around 10% of commercial of their loan book for commercial property is in the US and in Europe. So now that is risky, but at the same time, if you look at a lot of those loans have actually been originated by Singaporean companies, the large GLCs and a lot of the large Singaporean corporates that are going into these markets and doing transactions. So again, this is an area of concern, but this is something that we think can be managed. Now, turning to the highlight for me from the fourth quarter results was dividends. They actually surprised on the upside for their 2024 dividends. Dividends was up around 13% from the 2023 levels. Plus, they've also announced a 1-for-10 bonus issue, which with dividends kept static on a per share basis, which means that overall dividends if the bonus share happened in 2024 or 2023, the overall increase would have been around 24% of dividend increase. So that's actually quite a huge jump in dividends going into 2024. This has already pushed dividend yields up to about 7%. That is, much higher than even some of the Singapore REITs. But we think there is still opportunity for DBS to pay out even more. And largely because they've got quite a lot of excess regulatory capital on their balance sheet. So I think once a lot of the IT issues start to get fixed around the first quarter, second quarter this year, there are chances of more special dividends being paid as well. So that's something to watch out for. And we're keeping our buy call on that stock. Now, taking a step back and going out from Singapore and going to Thailand, we have Bunyakorn on the line. Bunyakorn, welcome to the show. Now, you've initiated on airports of Thailand. Now, before we go into your initiation, can you tell us a brief intro of the company?
Okay. So Airport of Thailand is the largest airport operator in Thailand. Currently, they operate 6 international airports. So that's about 80% of the total passenger total passenger in Thailand. So you consider as a monopoly business. So the good things about Airport of Thailand is if you compare with other regional airports, is because they have a lot of high revenue contribution from non-aero revenue, which is mainly from service and concession. That's about 50% of the revenue. So that part of it that AOT is trading at the premium compared with the regional airport. Yeah.
Okay. So it's a little bit at a premium. The stock's actually been down about 12% in the past year, but you've initiated with a buy with a target price of 77 baht. What's driving your conviction?
So if you look back in last year, stock performed really bad compared with other tourism-based stock. Hotel went up very well. Airport of Thailand underperformed. Mainly is from the passenger target cut, mainly from Chinese, which is last year we see only about a third of Chinese have back compared with the pre-COVID level. The first thing is the target cut of the passenger. Second thing is about concern of extension of the assistance measure. AOT has been helping, concessionaire and airlines, giving discount, giving postponement payment. I don't think that will be more after this Chinese New Year. So we have seen a lot of Chinese coming back. February number is doing well. We see daily pace in February this month at about 72% compared with the February in 2019. That's a very good number. So I think the stock fell off last year. I think it's priced in. So we expect some quarterly performance earnings improving in the next 2 or 3 quarters.
Right. So a lot of the bad news is already priced in. And you said the quarterly performance will improve. They've just, I think, released their quarterly numbers, right? What are some of the key takeaways from that?
So last night earnings announcement, the net profit came in at about 4.6 billion. Bloomberg estimated about 5.1. So that's about 9% to 10% miss. So mainly it's from expand. Depreciation has been rising sharply because of the new terminal opening. And one of the key negative factor is the concession revenue, which is below the consensus estimate. So we have costs we should be seeing the peak of cost, especially in depreciation at this quarter. So next quarter we wouldn't be more increased. Concession revenue should be improving in the next quarter because of the Chinese tourists. Normally they spend a lot in duty free. Spending per head for Chinese is relatively higher than from the Western side. So if you see at daily pace of Chinese at 70% or above, I think we should see earnings a lot of improvement in the next quarter. So stock went down today about 2 to 3%. I think they will have analyst meeting this afternoon, so I think everything will be qualified. Yeah.
Okay, perfect. That's good. But what are some of the downside risks to your buy call, Bunyakon?
The downside, right?
Yeah.
Downside is if you see there's a news on the Ministry of Finance is consider cancel the duty free on arrival. That's to support the local retailer. That's part of it that make the stock went down in the past year too. I think stock from 70 baht to about 60. That's price in the for the cancellation of the duty free on arrival. We think that it will impact about 3 to 4% of earnings, and I think that's one of the key downside if there's a permanently cancellation. So the other thing is about tourist recovery. Obviously, good performance in February, but looking to the low season, I think earnings consensus is about now forecast is about 22 billion. There's a bit of downside if the low season is not doing well. Like in a low season, it's probably during the month of July to September. So we think we could be a downside from there.
Yeah. Okay, great. Thanks, Bunyakon, for joining us, and thanks for your call. So we have a buy on Airports of Thailand. Target price is 77 baht, which is about 19% upside from here. Also, note that Thai Airport of Thailand is available as a SDR on SGX, so you can actually trade it directly in Singapore dollars on the Singapore Exchange as well. Now, finally, I talked about a gem of a small cap stock, and that's DYNA. It's a $300 million market cap EPC contractor for the oil and gas industry. It's been sold down heavily over the last 3 months or so, and we think that's overdone. Especially as Jarek is expecting a blockbuster set of fourth quarter results to close 2023. Results should be out towards the end of this month. And he's actually looking at earnings to grow about 30% year on year in the fourth quarter. More importantly, DYNA is acquiring Exterran Offshore and also leasing more land from JTC. This will actually help them grow their overall capacity by around 50 to 60% going into this year. This will put them in a very, very good position to add on another 200 to 400 million Sing dollars of orders in the first half alone. Their order book right now is around 630 million. So that's a very chunky sort of increase in their order book, given the new capacity that they have. Plus, if you actually look at the FPSO charter rates, FPSOs are the vessels that DYNA builds the topsides for. The charter rates are actually still going up, particularly with the uncertainty around the Red Sea area as well. So there are some very powerful catalysts out there for the stock ahead of results. Our target price is 38 cents. So there's quite a bit of upside from where the current prices are. So do have a look on DYNA. Now, We're running out of time, so let's go to some of the upcoming dates and events. We've got quite a lot of results coming out over the next few days. The last of the Singapore REITs are coming out. Tomorrow we have Far East Hospitality Trust. We've got Elite Commercial REIT on the 19th of February. DYNA is out on the 20th of February, as well as Sembcorp REIT, Sembcorp Industries, as well as First REIT as well. So do watch out for that, and do subscribe to our daily newsletter, which will have summaries and quick takes on a lot of those results as we go through the results season. With that, let's also look at some of the events that are coming up. Do join us for our next Market Monday on the 19th of February. And also on the 29th of February, on the leap year day, we have Lion Nomura having a webinar on the Japan Active ETF. Japan very clearly saying that they're not completely done with the central bank, saying that they're not completely done with easing. So there could be still a lot more wind behind the sails for the Japanese equities. So this is actually quite a good and timely seminar to join for. So you can scan the QR code or speak to your salesperson to join these webinars. And with that, unfortunately, we've run out of time today. So thank you so much for joining. Thank you for your support, and have a profitable trading week.